Reserve Bank of India has released its annual report, making it clear that it is worried about a severe slump in growth, blaming pronounced shifts in the economy that were largely unanticipated. The central bank has raised the red flag on growth, also adding that its outlook is clouded. The Reserve Bank of India has singled out reviving consumption and private investment as its highest priority. It has called for structural reforms in labour laws, taxation and the judiciary to fulfill the vision of India becoming a $5 trillion economy in the next 5 years.
Okay, another prescription for the economy by the RBI is to strengthen the non-banking financial companies. Now, RBI has promised more transparency and harmonization and bolstering the surveillance mechanism. Ritu Singh is here with all of the details. Ritu.
In light of the recent crisis that engulfed the NBFC sector, RBI has prescribed certain norms that it will follow in this financial year to strengthen the overall infrastructure for NBFCs, starting with stronger disclosure requirements for NBFCs, which will ensure transparency and also build confidence in the system. Secondly, the exercise of harmonizing the regulatory framework for NBFCs. That will also be pursued in this year. The aim really is to bring down the number of categories of NBFCs, something that RBI has highlighted in the past. The idea here is to have more activity-based regulation rather than entity-based regulation. There will be concerted efforts, according to RBI, that will be made towards more strengthening for all the supervisory pillars of NBFCs. For instance, the inspection of banks and NBFCs will now be carried out together to be able to gauge the interconnectedness between the two, so that, in the event of a failure of one large NBFC, there are no ripple effects, that takes the system by surprise. For instance, there will be a concept of a senior supervisory manager who will be appointed as the central point of contact for large NBFCs and for group of NBFCs. And lastly, there will be on-site inspection as well as off-site surveillance mechanism that will be strengthened during the year.
All right, Ritu, but stay on. The RBI annual report also showed that the value of bank frauds have risen by 74%. What's the explanation there?
Well, the RBI hasn't actually given an explanation of why we've seen this kind of rise in the number of frauds in just a period of 1 year. But in the aftermath of the Nirav Modi fraud, the government had asked banks to investigate all bad loans of over 50 crore rupees for frauds. And we understand from banking sources that they were urged to declare even minor transgressions as frauds. Perhaps to some extent that could explain the number of rise in fraud cases that we've seen in this year. But in terms of the number of frauds declared in FY19, that has gone up by 15%. But the value of frauds is a staggering rise of 74% at 71,543 crore rupees. If you segregate between public and private sector banks, the value of frauds declared by public sector banks is up 68%, whereas the value of frauds declared by private banks is up 122%, although in the absolute number terms is much lower than the public banks. The number of frauds, if you look at the division between public and private sector banks, public sector banks accounted for 55% of the total number of frauds declared in FY19, and private sector banks accounted for 31%. In terms of value, public sector banks had the lion's share at 90% and private banks just a little over 8%. So that is how the division stands. Now, why is it concerning that, the number of fraud detection, the time taken to detect large frauds of over 100 crores took 55 months is because if you look at the 72,000 crore rupee figure for FY19, 52,000 crores or more of the the value of those frauds came from accounts that had exposures of over 100 crore rupees. And if it takes banks 5 years to detect these kind of frauds, it certainly is a cause for concern.
Ritu, thanks a lot for running us through all of those details. It's time for us to slip into a short break.